Welcome back. Well, the HDFC Nifty suggesting a flattish start. Anuj joins us in the studio as well. Well, Anuj, what a heartening performance, right, from the Nifty yesterday, ending more or less flattish when global markets were in a dizzy. How do you approach trade today?
Yeah, I mean, yesterday was, like we discussed, the same movie playing out again. What about today? Well, the Indian market, of course, remains the best performing market. My sense is, Nigel, today we might have a date with all-time high on the Sensex. We are just 1% away from all-time high on Sensex. So, if not today, maybe, then early next week, perhaps. Now, in terms of global cues, the news coming out of China is very interesting, though the Hang Seng market is up 5%. That China is not budging from that zero COVID policy, and a lot of investors, leaders being Tiger Global, are now trimming their China positions and putting that money into India. So I think that's something which stands out. The other thing which stands out is the new economy versus old economy performance. In the Nasdaq, a lot of stocks are now approaching 2020 lows. Meta is already at 7-year low. Amazon yesterday almost broke 2020 low, and X of Apple, most of the stocks are almost breaking their recent lows. And the Nasdaq is very close to 52-week low as well. On the Nifty, we bounced from that support of 17,960 yesterday. In fact, low was 17,959. So that becomes your range again, 17,960 to 900, your line in sand. The texture is clearly buy on dips. The closer you buy to 17,960, 900, the better is your risk reward. On the upside, the congestion is around 18,200 to 300. IT is again unlikely to give major support, so the heavy lifting has to be done by banks, FMCG and autos, most of which in any case are close to all-time highs. On the Bank Nifty, 40,500 is now your line in sand, and my sense is you will test new all-time highs very soon. 41,800 thereabout. SBI has already hit new high ahead of its numbers tomorrow. ICICI Bank normally follows suit, and now you started to see buying in HDFC Bank as well. So that could once again be the index to focus on in today's trade. And of course, it's weekend as well. Though next week we have a curtailed week, Tuesday is market holiday, so there could be some volatility today and on Monday.
Best news of the day, right? Tuesday is a market holiday coming up.
Market holiday of the year.
Yeah, I know he said that already, Nigel. Oh, he made us feel remorseful about that already. But thanks, Anuj, for joining in, and have a good one. So Deven Choksi is still sitting by. Deven, thanks for waiting by patiently. Today you have big numbers coming out. There's TVS Motor, which has been by far been the best auto stock, this year. There's Titan from the heavyweights. Anything that you still like?
Yeah, I think both the names probably are likely to show a much better performance. And I think going by the numbers that we have seen in case of autos, particularly in two-wheelers, I think the numbers are likely to remain stronger for TVS. And going forward in this quarter too, I think the numbers should remain very robust. So the direction also I think should be very, very strong coming out from TVS. So definitely I think it's a positive one. Including for Titan, I think with the festive season sales, and also I think now the marriage season sales, probably I think this should be one of the best quarters that the company would be reporting numbers. And also I think continuing in October, December quarter. So overall, I think the numbers are not doubted, but the fact is that the valuations have already scaled up. I'm not too sure how much further upside that one can argue for at current valuation. Those who are invested, definitely I think they will stay invested, but I think for buying afresh, certainly, I think my preference would be to look at the market when the opportunity is around at lower levels. So, from that point of view, I think one will have to wait for fresh buying, but otherwise, stay invested as far as the long-term investors are concerned.
Okay, all right, Deven. Well, thanks so much for joining in, discussing all those stocks. Wishing you a good Friday ahead. Well, UCO Bank, that's the stock on our radar. The company posted its highest quarterly profit in 7 years, and the asset quality has also improved, but the slippages continue to remain elevated at around 580 crores odd. Soma Shankara Prasad, the MD and CEO of UCO Bank, joins us on the show. Hi, sir. Good morning. Thanks so much for joining, and congratulations on a good showing. But, if we could address the slippages part first, it remains at around that 80 crores odd. Could you tell us what is the trajectory from here on a quarterly run rate?
Yeah. See, if you look at the slippages, last year the slippages were around 1,500 crores per quarter. Our total slippage for the entire year last year was at 6,000 crores. And now, as far as the slippages are concerned, they have come down to around 500 crores. Both in the June quarter as well as in the September quarter, the slippages are around 500 crores. And one more point I would like to bring to your notice, the slippages for this quarter are 556 crores. But the upgrade plus cash recovery is around 940 crores. That means our upgradation plus cash recovery is more than the slippages. So the slippages have considerably come down compared to the last year.
Okay, the slippages have considerably come down. So this quarterly run rate of 500 crores, right, in the June and September quarter, is that something that you can sustain in the second half, or do you think it can come down further?
See, we are actually looking at sustaining this rate in the coming quarters. That will be good for the bank. See, one major thing that has happened is that we don't have any major corporate account which is under stress. So, and the bank is adequately provisioned. We have a provision coverage ratio of almost 93%, which is, I think, perhaps the second highest in the banking industry. So, except for some concern in some of the retail accounts and agriculture accounts, we do not foresee any major slippage on the corporate side. So I think we should be able to sustain this run rate of 500 crores. And I think if we are able to do it, I think it will be good for the bank.
Mr. Prasad, are you how is the corporate growth, or are you kind of being cautious there in terms of not growing that too much? You want more granularity because of what has happened in the past so many years. And how is that going to impact overall loan growth going ahead?
Yeah. See, if you look at it, we have had a difficult time in the last few years, and that was because of the major corporate slippages. So ever since then, the bank has been concentrating more on the RAM sector. So the ratio right now is the RAM is about 60% and the corporate is 40%. Having said that, I should tell you that we have seen very good growth in corporate advances in this quarter because we find very good proposals on the corporate side which are coming in mainly in the areas of NBFC, infrastructure, cement, steel, banks and so on. So we have seen a corporate growth of 22% this quarter, but we are only going for higher rated corporates, A and above. So that we don't have the issues that we have had previously. Similarly, on the retail side, also we find that there is a strong demand for credit. So we have almost grown by 17% on the advances side. So now the major issue is that I think it is the issue for the entire banking sector that we have grown at 10.2% on the deposit side. So the liquidity has become a little tight. So that is going to be one of the major challenges going forward.
Okay, keeping all of that in the backdrop, sir, what kind of loan growth are you looking at for this year? And also your NIMs, they've come in at around 2.8% odd. Do you believe there's a downside risk out there? What kind of guidance could you give on that front?
If you look at the NIMs, our NIM this quarter is at 2.84.
Yes.
And look at the March NIM, it was around 2.74. So there is sequentially, there has been a 10 basis point improvement in the NIM. Okay. And we also look forward to further improvement in the NIM for the simple reason, as you are aware, we are in a raising interest rate scenario. So as and when the repo rate goes up, it has already gone up by 190 basis points in the last few months. All those loans which are linked to repo rate, the interest rate will automatically go up. Okay. So what happens is that it is good for the banks in a raising interest rate scenario that the NIM will definitely go up. So that is a positive for the banks. So going forward on the NIM side, I expect maybe another 5-6 basis points, the NIM should go up.
Okay, this is actually a very positive commentary, and I think this is the most optimistic I've heard, your management in a while. You're saying that the slippages will sustain at these levels. There's no major corporate account under stress right now and no major slippage on the corporate side, which is great to hear. On loan growth, what is the current trajectory and what's the expectation for the full year?
BSE, I think the banking industry is also growing around 15 to 18% as far as the loans are concerned. So we are also looking forward. See, half year the growth has been around 17%, 16.8 or 16.9. So going forward, we are looking at maintaining this trajectory, and we expect to grow somewhere around 17%.
All right, Mr. Prasad, we'll leave it there. Thank you very much for your time. Appreciate it very much, as always, here on CNBC TV 18. And hopefully things will turn around meaningfully for UCO Bank quarter after quarter over the next many. So that's the management of UCO Bank. Used to be one of the most stressed, but things are, there's a rising tide for PSU banks right now. And a lot of things are being fixed. 14.6, still one of the cheapest in amongst PSU banks, which generally, compared to the private banking space, are a far cry in terms of valuations. Mitesh is back with us. So there's about 6 minutes to go for market opening. Mitesh, 9-10 calls?
I'll go with the buy on Pharma Enterprises. I think, Prashant, it's reversing from a oversold level with a very strong turnaround yesterday. Buy with a stop at 880 for a first target of 930.
All right. I mean, Pharma also, the other one, did very well. I think ended higher for the second straight session. But Piramal Enterprises picked up pace back to about 900 or so. Amara Raja is going to be in focus as well on the back of earnings. Let's revisit that. Sonia.
So I think the reason why the stock is up 6%, right, in pre-opening is because the margins have been spectacular this time. It's been a 140 basis points year-on-year improvement in their margins, but the important bit is if you see the trend, the margins are above 13% after 5 consecutive quarters. So it was ambling in this range of about 10 to 12 odd percent and now back at 13% plus. Even the commentary from the management is very positive. So you have a robust demand in the automotive sector from aftermarket as well as the OEM segment. Exports are very healthy, especially in the Middle East and Southeast Asian markets. They say industry battery volumes have picked up quite a bit, especially in the telecom segment because of the 5G rollout in India. And now they've announced a fresh lithium-ion battery manufacturing subsidiary because of the pickup that we're seeing in electric vehicles. So all in all, good set of numbers, positive commentary, but the margin uptick is the big positive.
All right. Well, that explains why the stock is up by close to 5.5% in pre-open itself. But the other big winner in the second half of trade yesterday was Bank of India, and the management sounded extremely confident, and Abhishek said those numbers are quite good. He joins us to tell us what a brokerage is making of it. Abhishek?
Well, brokerages are surprised by the fact that, Bank of India reported such strong numbers. So we have Morgan Stanley who has written a note. They have upgraded the stock to overweight and raised the target price by nearly 80% to about 95 per share from 53 per share. So core operating profit has beaten them by 60% in terms of their estimate, helped by higher margins or the net interest margin that has spiked up. So they have raised earning estimate by more than 20% for FY24, 25, etc. And they expect ROA of 0.7% for FY24 and about 0.8% for FY25. We also have Credit Suisse on Bank of India. They have an underperformance rating with a target price of 42 per share. They say that the margin uptick has failed to lift the profitability. So they adjusted for the higher net interest margin and lower fees. They have raised earnings estimate anywhere between 3 to 6% over the next couple of years. So despite the macro tailwinds on asset quality and improving growth, core operating profit actually is weak for Bank of India is what they have said in their note. Back to you.
Okay, thanks a lot for that. A couple of more quick stocks to watch before the market opens. After Morgan Stanley yesterday, CLSA today has raised earnings estimates for domestic two-wheeler companies. So they have said that the two-wheeler industry volumes will now, they've raised their assumptions by 4 to 8% over FY 23-24. They believe that the festive season was very strong for domestic two-wheelers, and the higher volume forecast is led by the premium motorcycle segments. We've seen it with Aisha's spectacular numbers, as well as the scooter segment. We saw it with TVS. So they've raised their volumes estimates for Honda, Bajaj and Eicher, and this is the second upgrade coming in on Bajaj Auto in the last 2 days. Yesterday, Morgan Stanley upgraded the stock. Today, CLSA has upgraded it to a buy. They also maintain their buy on Eicher Motors, although they have downgraded TVS Motor to a sell because of the price appreciation, and they've downgraded Hero Motor to an underperform because of the weakness that we're seeing over there. But a quick comment from Vivek on IEX. Let's find out how that did. Vivek.
Well, that's right. So IEX, gave the October operational update, multiple headwinds playing out there. Volumes are lower on a year-on-year basis, both on the back of a high base, and lower REC in the renewable energy certificates also is lower. Improved availability of coal has ensured that prices too are lower, and along with that, sellers also have stayed away on the back of capping of prices. The management commentary in terms of the coming month also is that winter generally demand is lower, and they expect prices also to go low. So except some softness as far as IEX is concerned today.
All right, Vivek, thank you very much for that. So that's the commentary. There's about a minute to go for the market opening. It's absolutely flat. I mean, it's almost as if the market it's like a runner, right? I mean, or a hiker. I mean, you know, we've all experienced that, right? I mean, you
catching your breath.
You catch your breath. I mean, the fastest goes up, catches their breath, waits for the others to catch up, and I think it's something similar, perhaps, to that analogy. What is playing out here? So you don't go down. I mean, you wait there wherever you are.
I think in a marathon, what you do is you can't keep sprinting, right? You have to run a little bit and catch your breath. And if this is a big marathon that the Indian markets are seeing, then perhaps today is just the day when you take a bit of a pause. But 14 seconds left, just a couple of more stocks, right? Hero MotoCorp is your big loser after the numbers, so that's the big Nifty loser. And on the upside, it's Adani Enterprises. We spoke about that as well in our top 10 segment, up almost about 1.5%. So that's the first tick on the index. Not a bad showing at all, holding on to the 18,000 mark despite the weakness in global markets. The Bank Nifty is a tad bit in the green, so up about 150 odd points. Now the Nifty is picking up pace, so that buy on dips, or rather, you know, just buy whatever the scenario may be, is something that's playing out in individual names. So Adani Enterprises, Eicher Motors, Cipla, Hindalco, UPL are your top gainers right now, up anywhere between 1 to about 1.5%. Axis Bank is up almost about 0.8%. In fact, Adani Enterprises is not just your big mover today, but this week it's gained 9%. So it's had a big move this week. Keep an eye out on that. A lot of pharma stocks have also made their presence felt this week. Divi's Labs is up 7% this week and trending in the green this morning. Sun Pharma is up almost 5% for the week, but just a tad bit flat this morning, consolidating its gains. On the downside, there's Hero MotoCorp post its numbers. HUL, SBI ahead of its numbers is just a tad bit soft, but it's sitting at a 52-week high. Infosys is down about 0.8%. HCL Tech, TCS. So IT is not celebrating that much, just under a bit of pressure. And a couple of other names, Apollo Hospitals, DRL, a tad bit soft. But quiet start for the market, just buying time ahead of the big events. But there's, of course, lots more action in the mid-caps.
Well, that's right, Sonia. Lots of action actually in the mid-cap space. Amara Raja that Sonia spoke about, well, that one is flying in trade. It's up close to around 7% as we speak. JK Lakshmi Cement as well, the initial reaction was positive. Those numbers look better than what the street was working with. Let's pull up the stock out there. It's up close to 2%. Rain Industries as well, the numbers look pretty okay. So that stock was up close to around 2%. And a couple of other names. Vodafone Idea, well, that one was reacting to its numbers. I think it opened more or less flattish. So let's get that one up for you on the screen. But SKF's numbers, well, they looked rather good. That one has bounced up, I think, in trade. It's opened up well in the green, up 3.5%. On the flip side, Blue Star's numbers a little bit disappointing. So that one has got a bit of a knockback. And Orient Electric's numbers as well. Well, those numbers were very disappointing, actually. The margins came in at lower than 3% odd. So that was a disappointing set of numbers. Let's get that one up for you on the screen, down close to 4.5%. News reports indicate that, Indorama is joining the race for Polyplex. So maybe that stock should be in focus. Unconfirmed reports out there. Polyplex should be a stock that should come up for you. And Suven Pharma as well. The reports indicate that, in fact, a couple of PEs could potentially be looking at buying a stake in them. So Suven Pharma as well, up close to 3%. HOEC, Sonal tells us that there's an update that's just come about. And the company has resumed gas sales from its B80 field. Remember, this was suspended since mid-July. So that explains why that one has opened up with a gain of around 4%. A good start to trade.
And a great start, Nigel. Nothing to complain because given where the rest of the global markets, etc., are, so it's a solid one. 18,100 is back where we are. Vedanta is up about 2.5%. It's coming up with gains right now. Volumes are strong. Bank of India picks up for the third day in a row. This is, of course, in reaction to numbers. So 3% higher there. Raymond is up 2.6% with at about 1,292. The railway infrastructure stocks all did well. So you look at RITES, RVNL, and maybe a bunch of others. So actually these two coming up with volumes, so that's why I'm highlighting these. 2 and 3% gains on these respectively. Our colleague Nimesh, of course, had highlighted this on Editors Roundtable in the last episode. There is CRM Silk, if you can pull that up. Again, it's coming. It doesn't come up with in the top traded list, but it is today. It's up 10.5%. Again, I mean, one of those names where we had, I think, Abacus, which had sort of bought that one earlier, 10.5% on CRM Silk. Exide Industries is up about 4.5%. That is at 172. GMM Pfaudler is up about 4.5%. And Reddington, you'll hear from the management later, Reddington is up about 1.6 odd % as well. So this is a pretty good start. Market breadth is 3:1 in favor of advances. So, I mean, it's broader markets which are pulling away, even as the Nifty is kind of not doing very much. It's up about 40 points, but absolutely nothing to complain at all. That's the screen on your screens right now. All green, all higher by about 0.25% respectively.
Silk, actually, the numbers look very good. Big growth on the top line. The margins have come in at around 19%, 18.8%. That compares with around 13% on a sequential basis. And on a year-on-year basis, it compares with around 17.5%. So clearly, the street likes those numbers. Explains why the stock is up more than 10%. Sonia.
It has company in Amara Raja batteries, 10%
Flying
higher, flying away. So two stocks that, we're just telling you about details right now. Amara, CRM, Silk, all reacting to numbers. I think what's happening now is the market is rewarding good numbers.
Yes.
And not really, the disappointing numbers are sort of falling by the wayside, but the good numbers are being rewarded in a great way.
Oh, absolutely. There's one more. Cochin Shipyard. I mean, how can defense stay behind, right? So for all this week, day after day, we've had all these defense stocks pop up within the first 30 minutes, right in the top of the charts. So right now, for now, there is only Cochin. We'll see if the others. Data patterns is another one which is starting about 3% in the green at about 1450. There is HAL, the usual suspects, BEL, BDL, not yet, but we'll see. That's another area to watch out for. So this has been a very, very strong theme overall. All right, the market up 40. Let's welcome in our market master of the day, Andrew Holland, Chief Executive Officer at Avendus Capital Public Markets Alternate Strategies. Andrew, great to have you with us here. Thank you very much for your time.
Thank you.
This is absolutely a very strong market, Andrew. So the only question is, how does one how does one take incremental positions, sort of apart from your investments already? What are those? There are no real big bargains. One can make that point. It's a general comment, but I think that would generally hold true. Incrementally, what does one do?
So I think it's a good question, and it's a dilemma for a lot of investors locally as well. In terms of they can lock in 7.5%, a little bit more in some of the instruments in the debt markets, and feel comfortable there. So money is switching there. So whilst you've got incremental, I'm outside of SIPs now, but money that you have, you're saying, should I put more to equities? There's risk there. So you're looking for any kind of risk-adjusted type of funds, which will help you navigate some of the still headwinds that are out there. But to be honest, if you want to be safe, then a lot of investors are jumping into the bond markets to lock in some of those yields.
Okay. Well, the IT index, the Nifty IT index is dragging now, so not looking that great. By the way, Amara Raja Batteries is the stock of the moment, but it has Exide for company because these battery manufacturers. Now, the expectation, of course, is that after Amara's strong numbers, Exide will follow suit. Andrew, good morning. There's a theme that's playing out here, right? It's not just autos, but it's auto ancillaries, it's electric vehicles, the lithium battery manufacturers, all doing exceptionally well now. Under that whole umbrella theme, which is the space that there is still perhaps both value as well as growth headroom?
So I think in terms of growth, the autos and auto ancillaries, and particularly the electric vehicles, it's going to be it's not just a 1 year kind of thinking. It's a 2, 3, 5 years. So I think this is going to be a great space. And the way I think you can play it to little less, betting on who's going to be the winner. Say for electric vehicles in either two-wheelers or or passenger cars, would be the auto suppliers, auto parts suppliers, because they're going to have to be supplying. So you could say that XYZ might be the winner, but I would say that auto parts is probably the way I would play into this whole space at the moment, and there's still reasonable valuations there as well. I think the other thing on autos is obviously spending power is still there. People have still got money to spend, but I think as interest rates rise, we might start to see a slowdown in some of the order backlogs, shall we say, being filled. going forward. So not a sector which I think you should be out of, but I think I probably play it more to the auto parts side.
Hi, Andrew. Good morning. Andrew, what about the IT space? Quite a bit of the street is skittish on it, but the IT stocks actually have surprised in the last 40, 50 days or so. Do you continue to remain cautious on this space? If someone has it, do you think they should get out and get in maybe when we see a sharper correction, or are you changing that view on it?
No, we haven't changed our view. We're still very cautious on the IT sector. The correlation with NASDAQ is still very high. So, the more recent kind of rise that you saw in global markets, including the tech stocks, helped our companies as well. But you just can't walk away from the negativity that you're seeing in the tech stocks. And we saw it, again yesterday with Apple saying they're going to start to freeze hiring, Amazon going to reduce people. So the negativity there is going to continue to hit our sector. And I think interest rates rising in the US, did the Federal Reserve, Jerome Powell, did he pivot or not? I think he did, and I think we're just now guessing whether it's going to be 5%, which I think is probably right for the Fed funds rate. So all of that's known. But what I don't think is known is having seen, from virtually 0 to say 5% by early next year in the Fed funds rate, is that pain to the consumer and to businesses in terms of higher borrowing costs, higher interest costs, and so forth is yet to be kind of fully felt. You've seen it in the UK. The Bank of England, very interestingly yesterday said, we think the market's getting ahead of itself in terms of the expectation for interest rate hikes, which obviously hurt the currency. But we can't walk away from the fact that all of them are still hawkish on trying to get inflation down. So the pain is there. And for India, whilst I'm less worried and I haven't been worried throughout the year, but if the global recession does start to hit, that could hit our export to some extent, and that doesn't help us in terms of current account balance of payments, and that might be reflected in the currency at some point. So just something to watch out for as a headwind, as we're saying that India's decoupling from what's happening globally.
Absolutely. Well worth highlighting risks as well from time to time. The market, by the way, the Nifty is absolutely flat. It actually slipped into the red from that 40 points, disappeared. We slipped into the red, now back slightly 1-2 points, flat but higher in the green once again. The themes that we highlighted continue. The railway infrastructure stocks and the PSU banks like Bank of India. There is the odd defense name, Cochin Shipyard. Sierra Silk is up 17% now. It started 9-10% higher. That has continued to make its move today as well. Andrew, names like themes like defense, themes like railway infrastructure, which is largely made up of PSU stocks, right? Or even PSU banks for that matter. These are historically, on a consistent basis, they've not made money, but they are now, right? And a lot of times, a lot of big money is made when you buy when there is a lot of disbelief and and there is something changes. In defense, for example, one can argue that something has changed. Indigenization and focusing on making here is gaining prominence. We've seen that announcement after announcement. How do you approach some of these themes, and do you like them already? What's your sense?
So Prashant, if you remember, throughout most of this year, we've been saying that there's going to be a big capex cycle globally, and it would fall into two parts. One would be obviously defense spending because of what's happened in Ukraine and with Russia, and the second would be renewables. So that, just take that as a given. That is not going to go away. That's going to continue for the next at least 2 to 3 years in terms of heavy capex. The second capex cycle, or the second part of the capex cycle, is those industries and where there's a supply constraint or supply concern or security concern, and that's going to drive countries and companies to try and fill that gap. So for India, for example, semiconductors would be one. So as you see more and more companies come into India to address that problem of say, security supply, It's going to be those smart factories, smart offices. It's going to be the ABBs, the Siemens of this world, which will benefit. So yes, you'll have your normal CapEx cycle of roads and bridges, but this time I think it's going to be slightly geared towards those types of companies because of the difference in the CapEx cycle. The final thing I'll say on themes is something I've been highlighting just more recently, actually, is that with the problems with China, I think the electronics industry in India will have a boom time over the next 2 to 3 years.
Okay. Well, the space that's really picking up now is PSU banks. After the positive commentary from UCO Bank, that stock is up almost 2% odd. You have plenty of them. There's IOB, Bank of India. I mean, this is a theme that has played out for the last 6 months, and you do have both Bank of Baroda and SBI coming out with numbers tomorrow. Andrew, I do understand that this is a space that has, at best, given you good trading returns. It's not made investors much money over the last decade or so. Do you think this time could be different? Because we had some very positive commentary from UCO Bank saying that, the corporate slippages have gone down. There is no large corporate account under stress. How do you feel about this space?
No, I mean, obviously, the whole banking sector is saying this. I mean, Uday Kotak said we're in the Goldilocks moment. So, that applies to all banks. But I've always been of the view, because of maybe kind of governance issues on PSU banks. They are cheap, don't get me wrong, but I'd rather rent them than own them, which goes back to those trading times where you can make some very good money, but you don't necessarily want to own them for the long term because they really don't have. I'm talking about the smaller PSUs rather than the larger ones, where you would find that they just don't have the capability to gear up as the economy continues to grow. They'll do well, don't get me wrong, but I think the valuations was really the point of where you buy and trade it rather than own it.
Okay. We'll have to leave it at that, but just one comment before we let you go, because we're tossing to, the next segment where we're talking about consumption, a lot of these food companies. So Sapphire Foods is the one on our list. We've also seen some really good numbers coming from the likes of Devyani International. Is this a space that you like?
So interestingly, I was, in our morning meeting this morning, I was saying that one of the trends globally I think will happen is that as people trend down from maybe going out to restaurants and so forth because of the disposable income becoming lower, the fast food restaurants and will be the ones which will really start to pick up again. So I think I'm not saying that's a trend that will come in India very quickly, but it's something that I think we should keep a very close watch on because it'll have good sentiment for the whole of the sector.
All right.
Okay, Andrew, thanks a lot for joining in and giving us your thoughts on the market as well as the consumption space, which is a theme we're going to take forward. Sapphire Foods is a stock on our radar. Good set of Q2 earnings, but this was on a low base. The company's margins have improved versus last year on the back of operating leverage and lower employee costs, but the EBITDA has declined sequentially because of raw material inflation and seasonality. Sanjay Purohit, who is the whole-time director and group CEO of Sapphire Foods, joins us now to talk about that. Sanjay, thanks a lot for joining in. Can you just set the context of the interview by telling us how Q3 is shaping up so far and what kind of revenue growth are you penciling in for the full year?
So first I'll quickly talk about Q2 because I heard you say it's on a low base. So actually it wasn't on a low base.
Okay.
Q1 was impacted. Q1 last year was impacted by COVID, but Q2 was largely without any disruption. Perhaps a few pockets like Maharashtra last year were under a bit of strain, but Q2 was as normal a year as possible. And therefore, 36% growth over last year is a really strong performance. You have to also keep in mind that this quarter was potentially a very challenging quarter. One, from a KFC perspective, generally this quarter is soft because of the higher festival vegetarian sales days. And secondly, we are looking at inflation in the region of mid-teens. So we had to play a fine balancing act in terms of pricing to ensure that transactions don't drop. So transactions in the QSR space is the equivalent of volume growth. And I'm really happy to say on both KFC as well as Pizza Hut, we have seen good transaction growth. So quarter two itself has been a really good quarter. As we go into quarter three, typically, sales improve because there are very few vegetarian festival days. December itself is a strong month. And now right up to perhaps quarter one of next year, we see very few days when people turn vegetarian. This is important from a KFC perspective, also from Pizza Hut.
All right, non-vegetarian quarter coming up. Sanjay, hi, good morning. Great to have you with us here. Appreciate your time.
Good morning. Nice to be back on your show.
Great to have you. Just a quick point. I mean, the people always compare both for Pizza Hut and KFC margins for you and margins for Devyani, naturally, right? And the gap has narrowed quite a bit, especially for Pizza Hut. In the case of KFC, the gap is still some 350 odd basis points, 360 odd basis points. Could you give us some trajectory on how this will proceed? Where is, out of the two, where is there more room to improve margins? Because of due to operating efficiencies and other factors. Go on.
So quickly, we've got to look at where we started from. So 4-5 years ago, both these brands had restaurant EBITDA margins in the lower single digits, so 5 to 7%. Now you see KFC inching up to between 18 and 20%, and Pizza Hut in the mid-teens. And this is what we had called out on both the brands, that as we improve sales and as we drive a cost optimization agenda, and as we get to smaller stores that are far more efficient, we will find our restaurant EBITDA numbers improving. It's especially true on Pizza Hut, because Pizza Hut, many people looked at us even perhaps a year ago and didn't believe the story that we were telling. The omni-channel model where dine-in, delivery and takeaway, all three channels come into play, this optimizes the use of an asset. And if you see, as we progress, as we open new stores, the new stores on Pizza Hut deliver mid to high teens margin, and our overall profile is, will improve. So we've always said on KFC, in the region of 20% restaurant margin is what we would be happy with. And then we drive new store expansion quite strongly. On Pizza Hut, we moved from 10% last year to now 15%. Perhaps there is still opportunity to move this up. Our new stores that we have opened since April 18 are in the region of mid to high teens, so better than the average brand. So I think KFC in this region, Pizza Hut, perhaps there's opportunity to improve further.
All right. Hi, Sanjay. Nigel on this side. I put out a piece on Sapphire as well, and I highlighted a couple of aspects why the valuation wasn't as much as another listed peer. One of the factors were margins were a little bit lower, but as you're saying, you'll have put some levers in place and expecting things to improve on some part of your business. So for FY24, in the can we expect margins in excess of around 20%? Point number one. And Sri Lanka was the other pain point. Are you seeing signs of revival out there? You'll have reduced your exposure quite drastically out there, but are things now on the mend?
So I won't give a specific guidance on a specific year, Nigel. We've resisted from doing so. What we have said are two simple things, that over a 3 to 4 year period from FY21, we expect revenue growth of 25%, EBITDA growth of between 30% to 35%. Over a 3 to 4 year period, there will be years when we go above, there will be years when we go below. And a new store expansion rate where between, say, 130 to 160 stores, which will mean that we'll double our base as of December 21, when we had 550 stores. So this is the broad guidance that I'd like to give and continue to give. On Sri Lanka, we've not reduced exposure out of any purpose that we've had. It's just because the Sri Lankan rupee has depreciated versus the Indian rupee, and therefore you're seeing this a significantly lower contribution to our EBITDA. The business there continues to do well. We just opened our 100th Pizza Hut store. I was there for that launch. Things are stabilizing in the country, but still, I would say, critical out of ICU in a normal hospital ward, but stable.
Okay.
But the business there is absolutely fantastic. We've opened a 7th Taco Bell store, doing well.
Okay, I'm sure. I mean, in such a tough market like Sri Lanka, right? Not just with the way the currency has panned out, but the whole political situation there, the energy crisis there. I mean, it's great that the business is stable for you. Just a larger question. I'm sure this is a group level decision, so you may not be able to comment entirely, but still your thoughts. Does it make sense at any point to either sell or merge with Devyani International? I mean, both the companies, have the same brands, they do the same work, of course, different franchises. Just trying to understand that what's the point of sort of having two different entities?
So that's really a decision that the franchisor Yum took 6-7 years ago when they were looking at consolidating 8 different franchisees. At that point in time, they could have given it to one franchisee. They chose to, at that time, to look at another franchisee, and that's how Sapphire Foods came into existence.
Right.
When we came into existence, our aspiration was, how can we be the best restaurant operator in the country? We started off with KFC and Pizza Hut. We will become a platform play, so some point in time in the future, perhaps add a third brand. I think right now the trajectories are different. There's nothing wrong with that. I think it's perfectly all right. I think both the companies work closely together, and with Yum, we drive business together. So I think it's a perfect situation, if you ask me.
Right. So I got that. So that's a decision a larger decision, which perhaps we'll see. Another question, which again, I mean, maybe.
Sorry, Prashant.
Yeah,
it's a decision even in our hands. So we choose to also be independent.
Yes.
So there's no decision that needs to be made at a group level.
Yeah.
I just want to.
No, absolutely. Point again. Just one more point. I mean, and again, this question perhaps is better addressed to investors, but we have you on, so I'm going to ask this. This is the pre-IPO investors, right? The lock-in for who I think finishes now. I mean, it's almost going to be a year. And they collectively own just under 20% in the company. Have you sort of had, I'm sure that, investor calls and regular interactions with your large investors, you get a sense of how they're thinking and feeling about the business. Anything you can share with us?
Yes, of course. So at the IPO stage, we had restructured our shareholder base, and therefore 52% is promoter and promoter holding. They have just come into the business, so there is absolutely no pressure to sell. 28% was on offer at the time of the IPO, so that makes it about 78%. This is in the hands of public. There was about a 4 to 6% block that one of our investors sold about a couple of months ago. So that's also now public. So that's about 34. About 4% is with employees. So that leaves about 10-12% in the hands of perhaps 2 investors who have been with us ever since Sapphire Foods was founded. Now, if you ask most of them from the way that the business is performing, I'm sure they will take the right kind of calls. But the extent of shares that could be available post November 18th when we had our IPO, in my mind, is a small, sum of shares.
Sanjay, what about the promoter entity? That's PE owned as well. They intend to continue, right? Because that's the other overhang that some part of the street talks about, that this is PE owned, the other company that's listed, it's not PE owned, so that's why they're getting a higher multiple. There's a big difference in the market capitalization, so I ask you this.
Yeah. So I think there is a general lack of understanding of how private equity operates. Many of the people who came in at the time of the IPO, they've just come in, and therefore they've got a much larger window of opportunity to stay in the company. There is a portion of this equity that is locked in perpetuity.
Yes.
Because of an agreement with Young. So 25.1% of this 52 is locked into perpetuity. So private equity not necessarily needs to be able to sell over a short period or a medium period of time.
Yes.
Today there are private equity companies that are taking calls over a much longer duration, because really that is when true value and exponential value is unlocked in the India market.
Got it, Sanjay. Sometimes it's clarification that's required from the from the one that's running the company. In this case, it's you. So I ask you that question. As you said, half of the holding of the promoter entity is going to be held till perpetuity. Thanks so much for clarifying, giving us the
Is that number, Sanjay, you said the available for share, according to you, that's about 12%. Is that the number?
Yes, and out of that, I would be surprised if, I don't want to put a number, but
But you were about to, so you're welcome to.
Yeah, but given a choice, I'm sure people would love to stay in the company. There are some funds which will have some amount of pressure to say that there is a fund life, and they've been with us for 7 years, Prashant.
No, absolutely. I mean, the fund life, sometimes it's technical in nature and those sort of things. So thank you very much for joining us, Sanjay. It's a pleasure. Good luck with the business and great chat as always. Thank you.
Thank you, Prashant, Nigel, and Sonia. Lovely to chat with you all.
Thanks so much.
Thanks a lot.
All right, we'll take a very quick break here. On the other side, we'll be joined by the managements of Indigo Paints and Mahindra Life Spaces. Both reported numbers. Indigo Paints saw a very large rally yesterday, and Mahindra Life, of course, reported a little later in the day. So those conversations coming right up.